Tariffs are affecting the gold market. Might they affect the silver market as well? And could we see a tightening in physical gold and silver? This and more coming up. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Bill Holter joins us today. Bill has worked as a retail stockbroker for some 23 years, and today, amongst the many hats that Bill wears, he is also a precious metals expert and broker with Miles Franklin. And we're delighted to have Bill join us once again today. It's time to saddle up and silver up for Bill Holter. Bill, welcome back to SBTV. How are you doing?
I'm well. Thanks for having me back, Patrick.
Thanks for coming back on. Really do appreciate it. Seems like the more we spend some time together and speak with each other, the more the world is continuing to change and that needle is moving towards more uncertainty. First question here, the movement of gold from London to New York because of the fear of tariffs. What's your take on this?
Yeah, I don't think it's because of fear of tariffs. I think it's unloading of gold. I think they understand that the world is dividing, and the gold does not reside in the United States. So I think they're unloading gold, preparing for what's coming.
From what I understand, the vaults in London, I think it's like some 5,000 plus metric tons of gold they can hold, and I think they shipped out roughly about 400 tons. So there's still that question, where's the rest of it, and why the long delivery time?
Well, they may say that they have 5,000 free tons, if you will, but I think those are encumbered. I think they're owned by people. I don't think there's any way they could take that 5,000 tons and ship it anywhere. I think it's spoken for. So I think the number, 400, I think the last number I saw was 435 tons. I don't know what the real number is. Is it 800 tons that they could actually ship? Is it 2,000? I don't believe in any way it's 5,000 tons.
I mean, to be fair, I could be wrong with my numbers as well, but the point being, maybe none of us certainly really truly know. So there is still that a bit of opaqueness, the non-transparency in the gold markets. But
yeah,
having said that,
I do want to mention, Patrick, you said, why is it taking so long? I would ask, why can they do this so quickly when back in 2013-14, if you remember, Germany requested their gold back, and it took 3 years to get 300 tons. And back then I wrote a couple articles. I did the research and found out that a 747 cargo plane can hold 95 tons. So they could have shipped that in three full plane loads and then a fourth one to finish off the rest. And obviously it could have been done in 2 weeks, but they explained, no, it's just too much weight. It's too valuable of a cargo to do in large shipments. And it took 3 years before Germany got all their gold back. However, it was not their gold originally. The gold that Germany originally deposited, it was not that same gold. They came back with different serial numbers, different earmarks. They did get ounce for ounce or ton for ton or whatever, what they had originally deposited, but it was not their gold. So then the question is, what happened to their gold? And I think the clear answer is that gold probably got leased out and was sold into the market and used as part of delivery for their capping operations. And they got called out on it, and they did make good, but they did kind of pull up their skirt and show that it was not Germany's gold that was originally deposited.
I do remember that time and how the hallmarks, they were different from the original bars that
Right,
went in, so they
right.
received different bars. So, right, the question is, so obviously that gold did not just sit there; it went somewhere.
Yeah, the question is why. And I don't think you have to be a conspiracy freak, although most all conspiracy theories seem to have either come true or are coming true. But I don't think you have to be a conspiracy freak to ask the question why, and then your mind goes to, well, probably because that gold was gone, they didn't have it.
But with this, with what we're talking about right now, do you foresee a physical gold tightening in the market coming?
There is a physical gold market tightening already in place, and I mean you're seeing that. You're just seeing that on COMEX. You're seeing it because LBMA is having to ship metal. I mean, 400 tons. That's a lot. That's more than what COMEX delivers probably in a year's time. So there's already tightening from the standpoint of big money. I can tell you the retail demand in the United States has definitely slacked off, and we're now seeing a huge amount of sellers. And I think that's a function of the real economy has been much softer than has been reported. People have eaten into their savings, and they're liquidating gold, they're liquidating silver to survive. I think the real story, when all is said and done, is not going to be gold, but I think it's going to be silver. And I think the March delivery month is already starting to shape up where there could be huge delivery demand and potentially a failure to deliver. And I've said all along, I thought that the fuse would be silver. And once that went off, then gold would immediately go off. So I don't think there's going to be. I do believe that the deliveries will be done for February gold on the COMEX, but I think the real problem is March silver.
Okay, we'll keep an eye on that one for sure because typically guys will say when it comes to price anyway, silver follows gold, so that gold price needs to confirm, and then that silver price will follow, and demand and things like that. But you're saying this time around there we may get to that point where there's a crossover and silver will actually lead and do its own thing, probably aside from gold.
Actually, if you look back, and I mean, you can look, going back to uh, the 1980 episode, just go look back, and you'll see that the reality is because silver is such a small market, that sentiment and flows affect silver far far greater than gold. And I guess the easiest way to explain that is in a bull market, silver goes up faster than gold, and in a bear market, silver goes down faster than gold. So, in my mind, the reality is that once there's a trend that has begun, silver leads, gold does not.
Okay, okay, that's a great point because a lot of people they'll ask, like the silver to gold ratio. I think we're at about 88, 89, 90, somewhere around there, and they'll ask, why isn't silver keeping up with gold price wise?
Uh, to this point, and I mean, obviously, we've had a pretty good run. To this point, silver has not kept up with gold in this particular move. But if you look at past moves, I mean, go back to what was it, 2010, 2011. Gold ran up to uh, $1,800, $1,900, but silver ran from, I think it bottomed at $15, $17 and ran to 50. I mean, that was a triple. And then you hit the top and silver bleeds out faster than gold. So I think if you look at past events, I mean, just look at just look at the correlation. Silver has more volatility than gold.
Something interesting last year with gold, the gold price reached 40 new record highs last year in 2024. Gold kept pushing market prices, and we didn't see those huge, large pullbacks much at all last year. So gold really held the price and it kept pushing. And I guess putting this in perspective, on average, almost every week or two, gold made new highs. So when you put it in perspective that way, what comes to mind for you?
I think just simply supply and demand. I mean, if you look at mine production, that has pretty much flatlined for both gold and silver. Uh, so the supply is not increasing. And if you go back to look at a chart, go back to I think it was October, November of 2023, when uh, the U.S. basically confiscated 300 billion of the Russian reserves. The following day is when gold took off. I mean, the bottom was made the day of the announcement that we were sequestering the Russian reserves. And that what that did was it created demand from sovereign central banks, sovereign wealth funds, and sovereign treasuries. Because these countries looked at what happened and they said, hey, if they can do that to Russia, they can do that to us and not even blink. So it's a way of foreign sovereigns, quote, getting out of the system.
If I recall, back in October of 2024, Russia, the draft federal budget for the coming year, this year, 2025, included plans for their central bank to continue adding their gold reserves, but for the first time, they were looking at including silver. So, what you think we may see more silver coming into play as far as reserves?
I'm not sure that silver is going to come into play on a country by country basis from a monetary standpoint. What Russia said was they did single out or highlight silver, but they did. I think in the announcement, if you go back, you'll see that they announced that they were going to continue buying gold, but that they were going to buy other commodities, including silver. So I think they highlighted silver, and I think that's an easy way, for them to shoot an arrow, if you will, at the West, because I mean, look, Patrick, if you and I know that there's been a deficit for the last 4 years, and this will be the fifth year in silver. If you and I know this, Russia knows this. So what did they do? They tightened down the screws because they've got people smarter than you and I that research this, and they fully understand that there's going to be a failure to deliver. Do they want to be the ones that go in and buy up $5 or $10 billion worth of silver and blow up the entire Western system? No, that would be like a declaration of war. But it works, and there's some traction by them saying we are going to buy some silver. I mean, that just creates additional demand.
It's another great point. You are correct in that they were also looking at platinum and other things there. So
Right.
yeah, absolutely correct there. But with that, central banks, they have continued to buy gold at a eye-watering pace. I think exceeding 1,000 tons for the third year in a row. And I think last year Q4 it was 333 or somewhere around there. So it really accelerated last year in Q4. Do you continue to see this pace where central banks will start to hold gold or more gold, because it looks like they're holding less dollars in reserves and holding more gold in reserves?
Well, I mean, what's their alternative? Why would they not continue to buy gold? They fully understand that the U.S. basically is an insolvent Ponzi scheme. So they understand that their holdings in dollars are going to decline. So they're looking at their balance sheet and saying, this part of our balance sheet is going to decline. How do we protect that? How do we hedge that? And the obvious answer, and truly the only answer from a monetary standpoint, is gold. I mean, yeah, they could do it with silver, but how? I mean, you can't go in and buy. There's no way that sovereign wealth funds or treasuries or central banks could go in and buy $5 or $10 billion worth of silver, because it doesn't exist. That would blow the market up. So they've got to do it in gold, which is more liquid.
And I guess staying with gold, of course, we have the BRICS, and there's still that tariff that was issued out where uh, the creation of a new BRICS currency or backing and currency to replace the U.S. dollar will bring them a 100% tariff. How do you think this is going to pan out?
Well, first off, I mean, if we go into actual trade wars, that's a bad thing. People can say, well, some tariffs have worked in the past. I mean, I would just go back to the 1930s, and I would do that. I would look at the 1930s because we look pretty much like 1929 right now. I mean, you've got overextended real estate, you have overextended equities, you have way too much debt in the system. The leverage is way too high. So making a comparison to the 1930s, I mean, the Smoot-Hawley Tariff Act came into place when, in 1930, 1931, and yes, the real economies were already turning down, but the analogy I used, that was like throwing sand into the gearbox. It will definitely slow the real economies, and when you slow the real economies, that means less cash flow, but the amount of debt outstanding still remains. And remember, interest rates are higher now than they were 2 or 3 years ago, so the ability to refinance isn't there, because what the majority of debt that is coming to maturity has lower coupons than the current higher coupons. So refinancing is not an option. So from my point of view, adding tariffs slows trade. It slows the real economy and thus slows or shrinks the cash flow thrown off from the real economy that still has to service the same amount of debt that was outstanding, and some of that debt has to be refinanced or rolled over, and those are going to be rolled over at higher rates. And a lot of those, I mean, look at commercial real estate. Many of those bonds or debt that's coming due, they don't make sense to refinance. So what happens? They just go belly up and turn the property back to the lender.
I want to touch on silver again. We mentioned the tightening that already exists for gold, and you mentioning the delivery for silver coming very quickly in a few months. You see silver tightening as well, a lot more so.
Yeah, I mean, if you look at look at the COMEX numbers. The amount of open interest for March has been increasing, not decreasing. And normally, by now you would already see it starting to decrease. And we saw this back in the middle teens, late teens, where the open interest would increase, and then going, say, a week to 10 days before the final date, you would see a collapse in open interest. And we couldn't figure out for, I don't know, 2, 3, 4 years as to how that was being done. And the way it was being done was those contracts were being laid off onto EFPs, exchange for physical. And those exchange for physical contracts were based out of London. So theoretically, the deliveries were being made out of London, not out of New York. And I guess, one way to look at it was, that saved shipping the metal overseas to COMEX to deliver. But the other thing is, the EFPs you really can't see behind the scenes. So you don't really know if the metal actually got delivered or didn't get delivered, or, there were rumors at the time that the EFPs were paying off 20-25% premiums in fiat for the owner of the contract to walk away and say, now we'll take the fiat, we won't take delivery. So, that very well could have been a way to relieve some of the pressure.
I remember hearing those things too, and I was just giving it time to see how it played out, how it panned out as well. But with the tariffs, getting back to tariffs and silver, Because a lot of silver is the demand is industrial demand. You think these tariffs may influence that silver price in some way?
If you add on top of the silver price 25% or whatever the number happens to be, some applications that there are some applications right now that basically the price of silver, uh, it's as high as it can go. I mean, if you add uh, another 10, 25, 50, whatever the number is percent as far as the tariff goes, then it makes the application, it makes it not work. And the price of whatever that product is has got to be raised. And, then you've got the question of, will that product still be used? Will they try to find an alternative to that product? The problem with silver is there's not an alternative to silver in so many of these different uses, whether it be solar, medicinal, technological. Silver's the best conductor there is. So there's not a replacement for it. So if the price of silver goes higher, what do they do?
I want to touch on the Fed just for a bit as well. They recently paused their rates, but how long do you think? What number are you looking at where they could actually possibly cut rates to where it would be too much at that point?
I don't know. In my opinion, longer term, and when I say longer term, I'm talking about, say, a year, the next year to 3 years. Let's say that the Fed does uh, continue to cut rates. At some point in time, foreigners are going to look at it and say, "Hey, wait a minute. I can get. I'm not sure if this is correct or not. I think it is. I can get 4.5% on a German bond. Why would I? Why would I accept 3% or 2% or whatever on an American bond? And what that's going to do is it'll weaken the dollar, and it'll make it harder for the U.S. to borrow and fund the 1 trillion, 2 trillion, whatever the deficit happens to be. Those deficits are going to be harder to fund without higher rates. So I mean, I've been asked this for the last probably 6 months, and it's my guess is the next huge move in interest rates is going to be up and not down, and it's going to be up because at this point there's zero risk premium. If you look across the world, there's no risk premium. I mean, there's some countries like Greece that pay less in interest than the U.S., and yet there's other countries. For example, I believe Russia pays. If they had to go out and borrow in the forex markets, if they borrowed, they would certainly pay more than what the U.S. is paying. But Russia's what, 17% debt to GDP? And we're 130% debt to GDP. Which one has more risk? So what I'm getting at is I think we're going to see higher interest rates based on a real risk premium being placed on the different debt securities worldwide.
That's another great point because I do also believe that the Fed, they are going to have to at some point begin raising again. And it's interesting because the current administration, they want those rates to go down, but the market may be telling the Fed we want the rates to go up. So I'm curious to see, how is this going to play out if the Fed and the administration aren't seeing eye to eye again.
It'll play out like a comedy slash tragedy because I mean you've got Trump. The guy's a real estate guy. The guy wants, he wants to borrow money and pay nothing. Who wouldn't? I mean, it just, if you could borrow money for free, why wouldn't you do it? Uh, that's the comedy part of it. The tragedy, I think, is that, well, the first thing that's going to go by the wayside is if the Fed were to acquiesce and lower rates like Trump wants, then that's proof that the Fed is not and never has been truly an independent entity. And one other thing, I think the whole yield curve worldwide is going to go higher, and that's just based on the simple math that the world collectively is now, if you look at the total amount of debt outstanding, it's over 300% of debt to GDP. So the entire world is awash in debt. And I think, the way to, and I don't want to use the word mitigate, but the way to compensate for that is that the lender gets a higher interest rate and the borrower has to pay a higher interest rate.
That kind of leads to my next question here with the inflation. Do you think it's under control? Do you think it looks like it may be starting to simmer and come back?
I think what we're seeing is inflation of the things we need and deflation of the things we have. You look at I just said, the commercial real estate market. I mean, those commercial properties are down, what, 40, 50, 70% from where they were just 5 years ago. So you're already starting to see deflation in that market. You're already starting to see stagnation in housing prices in many places. I mean, look at Florida. Florida has stagnated, and you're seeing pockets in Florida. You're even seeing pockets. I mean, I live, an hour or more outside of Austin, but Austin has stagnated. So you're seeing a lot of these hot markets cool down, and you're seeing some price drops. You're seeing more supply come onto the market. So you're starting to see deflation. And I mean, all it would take would be a week or 2 weeks or a month of equity markets around the world collapsing. And I mean, you could easily see a 20% drop in a month's time across the board. Well, let me take that back. If you see across the board a 20% drop, then you're going to see derivatives affected. Some of them blow up, and it will probably be, a complete disaster. But if you go back to last July or August, I forget when it was, the Japanese market, the Nikkei average was down 25% in 3 days. Now, is that was that deflationary? Yeah, if it persisted, it was. I think that's exactly what we're going to see is continuing inflation of the things we need, deflation of the things we have, and now they've added another wild card of tariffs. And I don't think people really understand. There's a lot of stuff that we don't make in the United States. And if we tariff them and raise the tariffs higher and raise the tariffs higher, a lot of products are not going to show up. There's going to be shortages of many things that we need.
I was going to ask, before you'd hear a lot of us in the YouTube space, talking about black swans, here and there. We don't hear much of those anymore, the black swan. So I guess I thought I'd ask you, where have they gone? Have they came at us one by one, event by event, and kind of swam on by, or they're still kind of building up in some ways, like you said, with the inflation, the things we need, and other things as well, the economy?
I'm not sure what the term I would use. I guess I would say that, we've had things happen. There would have been huge black swans 20 years ago when people were thinking right. But people have been so desensitized and so bombarded with news day after day after day after day that what would have been a huge black swan and people would have freaked out and go, oh my God, did you see that? Now it's like, oh, well, just add that to the list. So I don't think that the black swans have evaporated and gone away. I think it's the perception of these events has changed.
All right, Bill Holter, you've given us a lot to chew on here, whether it's gold, silver, economies, and things like that. So I really do appreciate that. And can you let the people know how they can follow you and hear more of your insights?
Sure. Yeah, you can go to my website. It's just simply billholter.com. There is a contact button there. There's several different categories. One is just the daily postings. I post all my interviews and other interviews of interest. And there is a tab. It's called Grizzly's Corner. This is written by a guy that if I had to have somebody in the foxhole with me during war, it would be this guy. He knows how to survive. And he's written probably a dozen articles with all kinds of links as to a guide to prepping, if you will. And it's real world experience on his part. So that's a great resource. I mean, it probably wouldn't take you more than a day to go through all of it. But then with all the links, I mean, you'd be going crazy trying to follow all the links. But a lot of the links are to products that he's purchased that he actually uses. I mean, this is a guy that he used to go into central Idaho with a pack of mules for 6 months at a time and come out, smelling like a rose. So it's very good. I think that's a very good aspect to the site, is that there's actual prepping. I don't want to call it advice. It's not advice, but it's real world tales of prepping.
Well, I mean, I want to thank you for the time you've given us, because it's our foxhole time, where we can jump in there with you and get to know the things we need to know. And hopefully it won't really get to those things, but it's also good to be prepared. So I thank you for that, and I hope we can do this again soon.
Thank you, Patrick.
That was Bill Holter sharing his views on precious metals and the economy. To see more of Bill's views and work, please go to www.billholter.com. If you like this video, please do subscribe, give it a thumbs up, and share. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.